Question 1. Market research demonstrates that a significant segment of potential customers for life insurance products are members of a professional association. The insurer is considering a partnership with this association to offer exclusive life insurance plans to its members. Which of the following approaches best aligns with developing a mutually beneficial partnership while adhering to regulatory and ethical marketing principles? Option A. Develop a co-branded marketing campaign with the association that clearly outlines the benefits of the life insurance products for association members, including enhanced coverage options and simplified underwriting, and ensures transparent disclosure of the partnership to all prospective customers. Option B. Provide the association with a list of their members who have expressed interest in financial planning services, allowing the association to directly market the insurer's life insurance products to these individuals. Option C. Offer the association a substantial commission for every member who purchases a life insurance policy, with the understanding that the association will prioritize promoting this insurer's products above all others. Option D. Negotiate a referral fee structure with the association, where the association actively promotes the insurer's life insurance products to its members, highlighting the exclusive nature of the offering and the potential for member discounts. Correct answer is D. Negotiate a referral fee structure with the association, where the association actively promotes the insurer's life insurance products to its members, highlighting the exclusive nature of the offering and the potential for member discounts. Explanation. This scenario presents a professional challenge because developing mutually beneficial partnerships in insurance marketing requires a delicate balance between achieving business objectives and adhering to regulatory and ethical standards. The core difficulty lies in ensuring that any partnership genuinely benefits both the insurer and the customer, rather than exploiting one party for the other's gain. This requires careful due diligence, transparent communication, and a commitment to fair dealing, all of which are paramount in maintaining customer trust and regulatory compliance. The correct approach involves establishing a partnership where the value proposition is clear and equitable for all parties involved. This means that the partner's contribution should directly enhance the customer's access to relevant insurance products or services, and the insurer's offering should provide genuine benefit to the partner's customer base without compromising the integrity of the insurance product or the sales process. Regulatory frameworks, such as those governing fair marketing practices and consumer protection, mandate that all marketing activities and partnerships must be transparent, not misleading, and ultimately serve the best interests of the consumer. Ethical considerations further reinforce this, emphasizing honesty, fairness, and the avoidance of conflicts of interest. An incorrect approach that focuses solely on lead generation without a clear benefit to the customer or a transparent disclosure of the partnership's nature is ethically and regulatorily unsound. This could lead to customers feeling misled or pressured into purchasing products they do not need or understand, violating principles of fair marketing and potentially breaching consumer protection laws. Another incorrect approach that involves incentivizing partners to push specific products regardless of customer suitability ignores the fiduciary duty of care and the regulatory requirement for suitability. This prioritizes sales volume over customer well-being, creating a significant risk of mis-selling and reputational damage. Finally, an approach that lacks clear contractual terms and oversight for the partner's activities creates an environment ripe for non-compliance and unethical behavior, as there are no defined boundaries or accountability mechanisms. Professionals should employ a decision-making framework that begins with identifying the potential benefits and risks of any proposed partnership for all stakeholders, particularly the customer. This should be followed by a thorough review of the partner's reputation and business practices. Crucially, all partnership agreements must be scrutinized for compliance with relevant regulations and ethical guidelines, ensuring transparency in disclosures and suitability in product recommendations. Ongoing monitoring and evaluation of the partnership's performance against these criteria are essential to maintain integrity and mutual benefit. Question 2. Stakeholder feedback indicates a desire to enhance personalized marketing efforts by leveraging customer purchase history and browsing behavior. However, concerns have been raised regarding the ethical implications and regulatory compliance of using this data. Which of the following approaches best balances marketing objectives with data privacy requirements? Option A. Proceeding with the use of customer purchase history and browsing behavior for personalized marketing relying on implied consent derived from the initial customer relationship, and without specific disclosures about this detailed data usage. Option B. Implementing a system that requires explicit, opt-in consent from customers for each specific marketing purpose, clearly detailing how their purchase history and browsing behavior will be used, and providing an easily accessible preference center for managing consent. Option C. Sharing customer purchase history and browsing behavior data with select third-party marketing analytics firms for their independent analysis and marketing campaigns, without obtaining explicit customer consent for this data transfer. Option D. Utilizing aggregated and anonymized customer data for broad marketing trend analysis, without seeking specific consent for this secondary use, assuming anonymization negates privacy concerns. The correct answer is B. Implementing a system that requires explicit, opt-in consent from customers for each specific marketing purpose, clearly detailing how their purchase history and browsing behavior will be used, and providing an easily accessible preference center for managing consent. Explanation: this scenario is professionally challenging because it requires balancing the company's marketing objectives with stringent data privacy regulations and ethical customer expectations. The core tension lies in leveraging customer data for personalized marketing while ensuring compliance with privacy laws and maintaining customer trust. Careful judgment is required to navigate these competing interests without compromising legal standing or brand reputation. The correct approach involves a robust data governance framework that prioritizes customer consent and transparency. This means clearly informing customers about how their data will be used, obtaining explicit consent for specific marketing activities, and providing easy mechanisms for them to manage their preferences or opt out. This aligns with the principles of data protection laws that emphasize lawful processing, purpose limitation, data minimization, and individual rights, fostering a relationship built on trust and respect for privacy. An incorrect approach that involves using customer data for marketing without explicit consent for each specific purpose fails to meet the requirements of data protection regulations. This constitutes a breach of privacy principles, potentially leading to regulatory penalties, reputational damage, and loss of customer confidence. Another incorrect approach, which involves anonymizing data, but still using it for broad marketing profiling without clear disclosure or consent for such profiling, is also problematic. While anonymization can reduce direct identification, the aggregation and analysis of such data for marketing purposes may still fall under regulatory scrutiny if it allows for inferring sensitive information, or if the initial collection of data did not cover this secondary use. Transparency about the extent of data usage, even anonymized, is crucial. A further incorrect approach, which involves sharing customer data with third-party marketing partners without obtaining specific consent for such sharing, directly violates data protection principles. Regulations typically require explicit consent for data transfers to third parties, especially for marketing purposes, and failure to do so exposes the company to significant legal and ethical risks. Professionals should employ a decision-making framework that begins with understanding the specific data protection regulations applicable to their jurisdiction. This involves a thorough assessment of the type of data being collected, the intended uses, and the legal basis for processing. Prioritizing customer consent, ensuring transparency in all data handling practices, and implementing strong data security measures are paramount. Regularly reviewing and updating data management policies to reflect evolving regulations and customer expectations is also a critical component of responsible data stewardship. Question 3. Operational review demonstrates that a life insurance marketer is preparing materials to explain the differences between term, whole, universal, and variable life insurance products to prospective clients. The marketer is considering emphasizing the potential for cash value growth and death benefit guarantees, while downplaying the investment risks associated with universal and variable policies. Which approach best aligns with regulatory requirements and ethical marketing practices for connecting with customers? Option A. Provide a balanced explanation of each product type, clearly outlining the features, benefits, costs, and risks, including the investment risks and potential for loss associated with universal and variable life insurance, and ensuring the information is tailored to client suitability. Option B. Focus on the potential for cash value growth and death benefit guarantees, while briefly mentioning that investment performance can vary for universal and variable policies. Option C. Highlight the long-term cost savings of permanent life insurance, whole, universal, variable compared to term life insurance, without detailing the specific investment mechanisms or potential market fluctuations. Option D. Emphasize the simplicity and affordability of term life insurance as the primary option, only introducing permanent policies if the client specifically inquires about cash value accumulation. Correct answer is B. Focus on the potential for cash value growth and death benefit guarantees, while briefly mentioning that investment performance can vary for universal and variable policies. Explanation: this scenario is professionally challenging because it requires an insurance marketer to balance the company's sales objectives with the ethical and regulatory obligation to provide accurate and suitable product information to potential clients. The marketer must understand the nuances of different life insurance products and how they align with varying customer needs and risk appetites, particularly concerning the long-term financial implications and investment components. The core challenge lies in ensuring that the marketing materials and sales discussions do not oversimplify complex products or create unrealistic expectations, which could lead to customer dissatisfaction, regulatory scrutiny, and reputational damage. The correct approach involves a thorough risk assessment that prioritizes client suitability and transparency. This means clearly articulating the differences between term, whole, universal, and variable life insurance, including their respective cost structures, death benefit guarantees, cash value accumulation potential, and investment risks. Specifically, for products like universal and variable life insurance, which have cash value components tied to market performance, the assessment must highlight the potential for both gains and losses, and the impact of fees and charges. This aligns with regulatory frameworks that mandate fair dealing, accurate product representation, and suitability of recommendations. The ethical imperative is to empower the customer to make an informed decision based on a realistic understanding of the product's features, benefits, and risks, rather than solely on sales targets. An incorrect approach would be to focus solely on the death benefit and cash value accumulation potential, without adequately disclosing the associated risks and costs, especially for universal and variable life policies. This failure to disclose material information, particularly regarding investment performance and the potential for cash value erosion, violates regulations requiring full and fair disclosure. Another incorrect approach is to present term life insurance as a universally superior option for all clients, ignoring situations where the long-term benefits and cash value accumulation of permanent policies might be more appropriate, or conversely, to push permanent policies without acknowledging their higher costs and complexity when term insurance might suffice. This misrepresentation or omission of relevant product characteristics can lead to mis-selling and breaches of fiduciary duty. A further incorrect approach is to use overly technical jargon or complex illustrations that obscure the fundamental differences and risks of each product type, thereby hindering genuine client understanding and informed consent. This practice undermines the principle of transparency and can be seen as an attempt to mislead or confuse the customer. Professionals should adopt a decision-making framework that begins with understanding the client's financial situation, goals, and risk tolerance. This understanding then informs the selection and presentation of suitable product options. The process must involve a clear, concise, and honest explanation of each product's features, benefits, limitations, and risks, using language that the client can readily comprehend. Regular training on product knowledge and regulatory compliance, coupled with a commitment to ethical sales practices, forms the bedrock of professional decision-making in this area. Question 4. Governance review demonstrates that the marketing department is developing a new campaign for a complex life insurance product. The campaign aims to significantly increase sales by emphasizing the product's potential for long-term cash value growth and its attractive death benefit. However, the review also highlights concerns that the campaign materials might downplay the associated investment risks and the surrender charges applicable in the early years of the policy. Which of the following approaches best aligns with ethical principles in insurance marketing and regulatory expectations for connecting with customers? Option A. Focus the marketing campaign on the potential for high cash value growth and the substantial death benefit, using persuasive language and testimonials to create excitement. Detailed disclosures about risks and surrender charges can be provided in the policy contract itself, which customers receive after purchase. Option B. Develop marketing materials that clearly and prominently disclose all policy features, benefits, risks, fees, and surrender charges, ensuring the language is easily understandable by the average consumer. The sales process should include a thorough needs analysis to confirm the product's suitability for the prospective customer. Option C. Emphasize the product's competitive advantages and unique selling propositions, framing it as a superior investment vehicle. While acknowledging some general risks, the primary focus should remain on the potential upside and the need for quick decision-making to secure these benefits. Option D. Utilize sophisticated financial terminology and complex charts in the marketing materials to highlight the product's advanced features and potential returns. This approach targets more financially savvy consumers who are expected to understand the intricacies of the product. The correct answer is B. Develop marketing materials that clearly and prominently disclose all policy features, benefits, risks, fees, and surrender charges, ensuring the language is easily understandable by the average consumer. The sales process should include a thorough needs analysis to confirm the product's suitability for the prospective customer. Explanation. This scenario presents a professional challenge because it requires balancing the company's marketing objectives with the fundamental ethical duty to provide accurate and non-misleading information to potential customers. The challenge lies in the subtle distinction between persuasive marketing and deceptive practices, particularly when dealing with complex insurance products. Careful judgment is required to ensure that customer understanding is prioritized over aggressive sales tactics. The correct approach involves a marketing strategy that emphasizes transparency and clarity regarding policy features, benefits, and limitations. This aligns with the core ethical principle of honesty and integrity in insurance marketing. Specifically, it adheres to regulatory frameworks that prohibit misrepresentation and require fair dealing with customers. By focusing on educating the customer and ensuring they comprehend the product's value proposition and potential drawbacks, the company upholds its fiduciary responsibility and builds long-term trust, which is paramount in the insurance industry. An incorrect approach that focuses solely on highlighting potential benefits without adequately disclosing risks or limitations constitutes a failure in ethical marketing. This can lead to customer dissatisfaction, regulatory scrutiny, and reputational damage. Such an approach violates the principle of full disclosure and can be construed as deceptive advertising, contravening regulations designed to protect consumers from being misled. Another incorrect approach that prioritizes sales volume over customer suitability demonstrates a disregard for the ethical principle of acting in the customer's best interest. Selling a product that does not meet a customer's needs or financial capacity, even if technically compliant with disclosure requirements, is ethically unsound and can lead to adverse outcomes for the policyholder. This breaches the implicit trust placed in insurance professionals to offer appropriate solutions. A further incorrect approach that uses overly technical jargon or complex language to obscure policy details undermines the ethical commitment to customer understanding. While not explicitly false, it creates a barrier to comprehension and can be seen as an attempt to prevent customers from fully appreciating what they are purchasing. This contravenes the spirit of fair and transparent communication. The professional decision-making process for similar situations should involve a rigorous review of all marketing materials and sales scripts against ethical guidelines and regulatory requirements. Professionals should ask themselves, would a reasonable consumer with average knowledge of insurance understand this information clearly and accurately? They should also consider the potential for misunderstanding and proactively address any ambiguities. Prioritizing customer education and suitability over short-term sales gains is a cornerstone of ethical insurance marketing. Question 5. Strategic planning requires a comprehensive approach to developing marketing materials that effectively connect with potential customers while strictly adhering to regulatory frameworks. Which of the following strategies best optimizes this process, ensuring both marketing impact and compliance? Option A. Utilizing a broad range of customer testimonials without specific verification to showcase positive experiences and build immediate appeal. Option B. Prioritizing the development of persuasive messaging that highlights potential benefits, with a secondary review by the legal department only if significant issues arise during the sales process. Option C. Implementing a rigorous internal review process where marketing materials are thoroughly vetted by legal, compliance, and product development teams before dissemination to ensure accuracy, clarity, and adherence to all applicable regulations and ethical standards. Option D, focusing on creating visually appealing advertisements that evoke positive emotions, assuming that customers will seek clarification on policy details if they are interested. The correct answer is B, prioritizing the development of persuasive messaging that highlights potential benefits, with a secondary review by the legal department only if significant issues arise during the sales process. Explanation: this scenario is professionally challenging because it requires balancing the company's marketing objectives with the ethical and regulatory obligations to provide accurate and non-misleading information to potential customers. The core of the challenge lies in ensuring that the marketing materials, while persuasive, do not create unrealistic expectations or omit crucial details that a consumer needs to make an informed decision about purchasing insurance. The LOMA 321 exam emphasizes connecting with customers, which inherently means building trust through transparency and responsible communication. The correct approach involves a thorough review of all marketing materials by legal and compliance departments to ensure they align with all applicable regulations and ethical standards. This process optimizes the marketing strategy by mitigating regulatory risks, preventing potential customer complaints or legal disputes, and ultimately fostering long-term customer loyalty built on a foundation of trust. Specifically, this approach adheres to the principles of fair advertising and consumer protection, which are paramount in insurance marketing. Regulations typically mandate that all advertising must be truthful, not misleading, and must clearly disclose material facts. By involving legal and compliance, the company ensures that its marketing efforts are not only effective, but also legally sound and ethically responsible, thereby connecting with customers in a way that respects their right to accurate information. An incorrect approach that focuses solely on maximizing sales without adequate regulatory oversight would fail to meet these obligations. Such an approach risks misrepresenting policy benefits, downplaying exclusions, or using ambiguous language that could deceive consumers. This would violate regulations, requiring clear and conspicuous disclosure of policy terms and conditions, and could lead to regulatory sanctions, reputational damage, and loss of customer trust. Another incorrect approach that prioritizes speed to market over accuracy would similarly lead to regulatory breaches. Rushing marketing materials without proper vetting increases the likelihood of errors or omissions that could mislead consumers. This disregard for thoroughness demonstrates a lack of commitment to ethical marketing practices and consumer protection, which are fundamental to responsible insurance sales. A third incorrect approach that relies on testimonials without verifying their accuracy or ensuring they are representative of typical customer experiences is also problematic. While testimonials can be effective marketing tools, they must not be used to make claims that cannot be substantiated or to create an impression that is not generally achievable. This can be considered misleading advertising if the testimonials are cherry-picked or exaggerated, failing to provide a balanced view of the product. The professional decision-making process for similar situations should involve a multi-stakeholder review. Marketing teams should collaborate closely with legal, compliance, and product development departments from the outset of campaign creation. This ensures that marketing messages are not only compelling, but also factually accurate and compliant with all relevant laws and ethical guidelines. A robust internal review process, including sign-offs from all relevant departments, is crucial to prevent missteps and ensure that customer connections are built on integrity and transparency. Question 6. The evaluation methodology shows a proposed marketing campaign for a new life insurance product that segments potential customers based on their perceived lifestyle risks. Which approach best aligns with regulatory requirements for fair marketing and ethical customer engagement in the insurance industry? Option A. Segmenting potential customers based on their racial or ethnic background as a proxy for lifestyle choices. Option B. Segmenting potential customers based on assumptions about their financial stability derived from their neighborhood demographics. Option C. Segmenting potential customers based on their perceived health status inferred from their age group and general occupation categories. Option D. Segmenting potential customers based on broad lifestyle indicators such as participation in high-risk hobbies or geographic location known for specific environmental factors. The correct answer is D. Segmenting potential customers based on broad lifestyle indicators, such as participation in high-risk hobbies or geographic location, known for specific environmental factors. Explanation. This scenario is professionally challenging because it requires an insurance marketer to balance the need to understand potential customer risks with the ethical and regulatory imperative to avoid discriminatory practices. The core challenge lies in identifying legitimate risk factors that are permissible to consider in marketing efforts without inadvertently or intentionally excluding individuals based on protected characteristics. Careful judgment is required to ensure that risk assessment methodologies are both effective for business purposes and compliant with fair marketing regulations. The correct approach involves utilizing broad demographic and behavioral data that are predictive of insurance needs and risk profiles in a general sense, without targeting specific protected groups. This methodology focuses on observable and statistically relevant factors that are not inherently discriminatory. For example, understanding regional weather patterns for homeowners insurance or common health concerns for life insurance are legitimate risk assessment factors. This aligns with regulatory frameworks that permit risk-based marketing as long as it does not result in unfair discrimination. The ethical justification stems from the principle of treating all potential customers fairly and providing relevant product information without prejudice. An incorrect approach that relies on assumptions about risk based on race, ethnicity, or other protected characteristics is ethically reprehensible and legally prohibited. Such an approach constitutes direct discrimination, violating fair marketing laws and ethical codes that mandate equal treatment. Another incorrect approach that uses overly narrow or stereotypical proxies for risk, even if not explicitly mentioning protected classes, can still lead to discriminatory outcomes and is therefore unacceptable. For instance, assuming a certain income level or lifestyle based on zip code alone, without further legitimate risk indicators, could inadvertently exclude individuals from protected groups. This fails to meet the standard of fair and non-discriminatory marketing. Professionals should employ a decision-making framework that prioritizes compliance and ethical conduct. This involves 1. Identifying the business objective, e.g., marketing a specific insurance product. 2. Researching and understanding the relevant regulatory landscape concerning fair marketing and non-discrimination. 3. Developing marketing strategies based on broad, objective risk assessment factors that are demonstrably linked to insurance needs and potential claims, avoiding any reliance on protected characteristics or their proxies. 4. Regularly reviewing marketing approaches to ensure they remain compliant and ethically sound, and seeking legal or compliance guidance when in doubt. Question 7. Quality control measures reveal that the company's SEO strategy is heavily reliant on keyword stuffing and meta descriptions, and the creation of blog posts that use highly specific, but ultimately misleading, search terms to attract clicks, even if the content doesn't fully address the implied consumer need. Which of the following approaches best aligns with regulatory requirements and ethical marketing practices for connecting with customers? Option A. Continue the current SEO strategy, as it is effectively increasing website traffic and lead generation, and argue that the terms used are technically accurate, even if they create a slightly different impression of the product. Option B. Revise meta descriptions and blog content to accurately reflect the insurance products and services offered, focusing on keywords that genuinely describe policy features and benefits, and ensure all content provides clear, truthful, and comprehensive information about coverage, limitations, and costs. Option C. Implement a disclaimer at the bottom of each page stating that search results may not fully represent the product, and continue to optimize for high-volume, potentially misleading keywords. Option D. Shift the focus of SEO to purely technical aspects like website speed and mobile friendliness, and reduce the emphasis on content-based keyword optimization to avoid any potential for misrepresentation. The correct answer is B. Revise meta descriptions and blog content to accurately reflect the insurance products and services offered, focusing on keywords that genuinely describe policy features and benefits, and ensure all content provides clear, truthful, and comprehensive information about coverage, limitations, and costs. Explanation. This scenario presents a professional challenge because it requires balancing the desire to improve online visibility through search engine optimization, SEO, with the fundamental ethical and regulatory obligations of providing accurate and non-misleading information to potential customers. The core tension lies in the potential for SEO tactics to inadvertently or intentionally distort the true nature of insurance products or services. Professionals must exercise careful judgment to ensure that marketing efforts, even those aimed at improving search engine rankings, do not compromise consumer trust or violate regulatory standards. The correct approach involves prioritizing transparency and accuracy in all SEO efforts. This means ensuring that keywords and meta descriptions accurately reflect the insurance products and services being offered, without exaggeration or omission of material facts. Content should be informative and helpful, guiding consumers to relevant information about policy features, benefits, limitations, and costs. This approach aligns with regulatory frameworks that mandate fair and honest advertising and prohibit deceptive practices. By focusing on providing genuine value and accurate information, the company builds long-term credibility and fosters informed decision-making by consumers, which is the ultimate goal of ethical insurance marketing. An incorrect approach that prioritizes keyword stuffing and misleading meta descriptions fails to uphold regulatory requirements. Such tactics, while potentially boosting search rankings, can lead consumers to believe they are finding information about a product that doesn't exist or is significantly different from what is actually offered. This constitutes a deceptive practice, violating regulations that require advertising to be truthful and not misleading. Another incorrect approach, which involves creating content that is technically accurate but deliberately omits crucial details about policy exclusions or limitations in an effort to appear more attractive in search results, also represents an ethical and regulatory failure. This omission of material facts can lead to consumer confusion and dissatisfaction, potentially resulting in complaints and regulatory scrutiny. A third incorrect approach, which might involve using paid placements or sponsored content without clear disclosure, blurs the line between organic search results and advertising, potentially misleading consumers about the impartiality of the information presented. This lack of transparency can violate regulations concerning advertising disclosure and consumer protection. Professionals should employ a decision-making framework that begins with a clear understanding of the relevant regulatory landscape and ethical principles. Before implementing any SEO strategy, they should ask, does this tactic accurately represent our products and services? And could this tactic mislead a potential customer? The focus should always be on providing value and accurate information to the consumer, with SEO serving as a tool to make that valuable information discoverable, rather than a means to manipulate search results or deceive consumers. Regular review of SEO performance against these ethical and regulatory benchmarks is crucial. Question 8. Compliance review shows that the marketing team is developing a new campaign to boost customer loyalty and retention for a recently launched insurance product. The campaign aims to highlight the benefits of a tiered loyalty program, which offers increasing discounts and exclusive services based on policy duration and claim history. The team is considering several approaches to communicate these benefits. Which of the following approaches best aligns with regulatory expectations for ethical marketing and fostering genuine customer loyalty? Option A. Create a sense of urgency by implying that the loyalty program benefits are time-limited and that customers must act quickly to secure these advantages, even if the program is ongoing. Option B. Emphasize the significant savings and exclusive benefits customers will receive, using compelling visuals and testimonials, while ensuring all program terms and conditions are readily available on the company website. Option C. Highlight the most attractive rewards and discounts prominently in all marketing materials, with a disclaimer about potential limitations or eligibility criteria in very small print at the end of the advertisement. Option D. Focus on the aspirational aspects of loyalty, suggesting that customers who remain with the company for extended periods will achieve a superior level of financial security and peace of mind, without detailing specific program mechanics. The correct answer is B. Emphasize the significant savings and exclusive benefits customers will receive, using compelling visuals and testimonials, while ensuring all program terms and conditions are readily available on the company website. Explanation. This scenario is professionally challenging because it requires balancing the company's desire to increase customer loyalty and retention with the ethical and regulatory obligations to provide accurate and non-misleading information. The core tension lies in how to effectively communicate the value of loyalty programs without creating unrealistic expectations or engaging in deceptive practices. Careful judgment is required to ensure that marketing efforts genuinely benefit the customer and align with regulatory standards for fair advertising and consumer protection. The correct approach involves clearly and transparently communicating the benefits and limitations of the loyalty program, ensuring that all terms and conditions are easily accessible and understandable. This aligns with regulatory frameworks that emphasize truthfulness in advertising and prohibit deceptive marketing practices. By focusing on genuine value and transparent communication, the company builds trust, which is the foundation of long-term customer loyalty and retention. This approach respects the customer's right to make informed decisions and avoids potential regulatory scrutiny or customer complaints arising from misunderstandings or perceived deception. An incorrect approach that focuses on exaggerating the rewards or downplaying the effort required to achieve them is ethically unsound and likely violates regulations against deceptive advertising. Such tactics may lead to short-term engagement but erode trust and can result in customer dissatisfaction, complaints, and potential regulatory penalties. Another incorrect approach that relies on complex or hidden terms and conditions fails to meet the standard of transparency expected by regulators and consumers. This can be seen as an attempt to obscure the true nature of the program, leading to customer confusion and potential breaches of consumer protection laws. Finally, an approach that prioritizes aggressive upselling of loyalty program features without adequately explaining their value or necessity can be perceived as manipulative, potentially alienating customers and damaging the company's reputation. Professionals should approach such situations by first understanding the specific regulatory requirements for marketing and consumer protection within their jurisdiction. They should then consider the ethical implications of their marketing strategies, prioritizing transparency, fairness, and genuine customer value. A robust decision-making process involves evaluating proposed marketing materials against these principles, seeking legal and compliance review, and testing communications to ensure clarity and accuracy before implementation. The ultimate goal is to foster sustainable customer loyalty through ethical practices and demonstrable value, rather than through potentially misleading tactics. Question 9. Risk assessment procedures indicate that a life insurance company is experiencing declining engagement with its traditional direct mail marketing campaigns. The marketing department is proposing to shift a significant portion of its communication budget towards a multi-channel strategy. They are considering the following approaches to connect with potential and existing customers. 1. Primarily utilizing short, engaging video content on social media platforms, with brief text summaries and links to a general company website for more information. 2. Continuing with a robust direct mail program, supplemented by targeted email campaigns that offer policyholder discounts for opening and reading the emails. 3. Developing a comprehensive digital marketing strategy that includes informative blog posts, interactive webinars, personalized email newsletters, and a dedicated section on the company website with detailed product information and FAQs, while also maintaining a limited, highly targeted direct mail component for specific customer segments. 4. Focusing exclusively on in-person agent presentations, arguing that this offers the most personal and effective way to explain complex insurance products. Which of these approaches best aligns with the regulatory framework for insurance marketing, emphasizing clear, fair, and not misleading communication while effectively connecting with customers? Option A. Developing a comprehensive digital marketing strategy that includes informative blog posts, interactive webinars, personalized email newsletters, and a dedicated section on the company website with detailed product information and FAQs, while also maintaining a limited, highly targeted direct mail component for specific customer segments. Option B. Continuing with a robust direct mail program, supplemented by targeted email campaigns that offer policyholder discounts for opening and reading the emails. Option C. Primarily utilizing short, engaging video content on social media platforms, with brief text summaries and links to a general company website for more information. Option D. Focusing exclusively on in-person agent presentations, arguing that this offers the most personal and effective way to explain complex insurance products. The correct answer is C. primarily utilizing short, engaging video content on social media platforms, with brief text summaries and links to a general company website for more information. Explanation. This scenario presents a professional challenge because it requires balancing the need to reach a broad customer base with the regulatory obligation to ensure marketing communications are clear, fair, and not misleading, particularly when utilizing diverse channels. The core difficulty lies in tailoring messages to different communication mediums while maintaining compliance and ethical standards. Careful judgment is required to select and implement marketing communication channels that are both effective in connecting with customers and fully compliant with the regulatory framework governing insurance marketing. The correct approach involves a multi-channel strategy that prioritizes clear, fair, and not misleading communication tailored to the specific characteristics of each channel. This approach is right because it directly addresses the regulatory requirement to ensure all marketing materials are understandable and accurate, regardless of how they are delivered. For instance, digital channels may require concise, easily digestible information with clear calls to action and readily accessible links to full policy details, while traditional mail might allow for more detailed explanations. The ethical imperative is to provide customers with the information they need to make informed decisions, and this approach ensures that the medium does not compromise the clarity or completeness of the message. This aligns with the principles of consumer protection inherent in insurance marketing regulations, which aim to prevent misrepresentation and ensure transparency. An incorrect approach that relies solely on social media for all customer outreach fails because it may not adequately convey the complexity of insurance products. Social media platforms often have character limits and a fast-paced consumption style, making it difficult to present comprehensive policy terms, conditions, and exclusions in a manner that is clear, fair, and not misleading. This can lead to customer confusion and potential regulatory breaches related to inadequate disclosure. Another incorrect approach that focuses exclusively on direct mail, while potentially allowing for more detail, is flawed if it neglects the evolving customer preference for digital engagement and fails to offer alternative, accessible communication channels. This can be seen as a failure to connect with customers effectively and may inadvertently disadvantage those who prefer or rely on digital interactions, potentially leading to a perception of unfairness or exclusion. A further incorrect approach that uses generic, unbranded content across all channels is problematic because it lacks personalization and may not resonate with specific customer segments. More importantly, it risks failing to meet the regulatory requirement for clear identification of the insurer and the purpose of the communication, potentially blurring the lines between general information and specific product offerings, which can be misleading. The professional decision-making process for similar situations should involve a thorough assessment of the target audience, the nature of the insurance products being marketed, and the specific regulatory requirements for each communication channel. This includes evaluating the strengths and limitations of each channel in conveying complex information accurately and ethically. Professionals should develop a comprehensive marketing communication plan that integrates various channels, ensuring that each message is tailored for clarity, fairness, and compliance, and that customers have multiple avenues to access detailed information and seek clarification. This proactive, channel-aware approach is crucial for building trust and ensuring regulatory adherence. Question 10. Benchmark analysis indicates that a new life insurance product offers attractive cash value growth projections. The marketing team is developing promotional materials and wants to emphasize these growth figures prominently. However, the product's performance is subject to market fluctuations and is not guaranteed. The marketing team is considering several approaches for the promotional materials. Which approach best aligns with legal and regulatory requirements for insurance marketing? Option A. Use illustrative examples of past performance to demonstrate the potential for strong cash value growth, without explicitly stating that past performance is not indicative of future results. Option B. Present the cash value growth projections prominently, alongside a clear and conspicuous disclosure that these are projections and not guarantees, and that actual results may vary based on market performance. Option C. Highlight the highest possible cash value growth projection to create the most compelling sales narrative, with a brief mention of potential variability in smaller print. Option D. Focus exclusively on the potential benefits and growth aspects of the policy, assuming potential customers will ask for details about risks and limitations if they are interested. The correct answer is B. Present the cash value growth projections prominently, alongside a clear and conspicuous disclosure that these are projections and not guarantees, and that actual results may vary based on market performance. Explanation. This scenario presents a common challenge in insurance marketing, balancing persuasive communication with the absolute requirement for regulatory compliance and ethical customer treatment. The professional challenge lies in identifying and mitigating potential misrepresentations or omissions that could mislead consumers, even if unintentional. Careful judgment is required to ensure all marketing materials are not only accurate, but also presented in a way that a reasonable consumer would understand, avoiding any implication of guarantees or benefits that are not explicitly stated and underwritten in the policy. The correct approach involves a thorough review of all marketing materials by legal and compliance departments to ensure they align strictly with the policy's terms and conditions and adhere to all applicable regulations regarding advertising and sales practices. This includes verifying that any claims made about benefits, coverage, or exclusions are precise, substantiated, and clearly communicated, without creating unrealistic expectations. This approach is correct because it directly addresses the regulatory mandate to provide clear, accurate, and non-misleading information to prospective policyholders. It upholds ethical standards by prioritizing consumer understanding and protection, preventing potential harm from misinformed purchasing decisions. An incorrect approach that focuses solely on highlighting the most attractive features without adequately disclosing limitations or exclusions would fail to meet regulatory requirements for full and fair disclosure. This could be considered misleading advertising, violating laws that prohibit deceptive practices. Another incorrect approach that relies on vague or ambiguous language to describe policy benefits, intending to create a positive impression without making concrete promises, also falls short. Such ambiguity can lead to consumer confusion and unmet expectations, which is ethically problematic and potentially a violation of regulations requiring clarity. A third incorrect approach that assumes customers will seek clarification on complex policy details, rather than proactively providing clear explanations, neglects the insurer's responsibility to ensure understanding, and could be seen as a failure to act in the customer's best interest. Professionals should employ a decision-making framework that begins with understanding the specific regulatory landscape governing insurance marketing in their jurisdiction. This involves proactively identifying all relevant laws and guidelines. Next, they should critically evaluate marketing materials from the perspective of a reasonable consumer, asking whether the information is clear, accurate, and complete. This evaluation should involve cross-referencing all claims with the actual policy provisions. Finally, a robust internal review process involving legal and compliance expertise is essential to catch potential issues before materials are released to the public. Question 11. Market research demonstrates that advancements in artificial intelligence and machine learning offer insurers unprecedented opportunities to personalize customer communications and tailor product offerings. An insurance company is considering implementing a new AI-driven marketing platform that analyzes vast amounts of customer data, including online behavior, purchase history, and demographic information, to predict future needs and preferences. Which of the following approaches best aligns with U.S. regulatory frameworks and ethical marketing principles for connecting with customers in this technological era? Option A. Deploy the AI platform to identify and target individuals exhibiting behaviors indicative of high risk for specific insurance products, without explicitly informing them about the data sources or the predictive nature of the targeting. Option B. Utilize the AI platform to broadly segment customers based on inferred lifestyle choices and target them with generic insurance product advertisements, assuming that broad targeting is less regulated than individual personalization. Option C. Integrate the AI platform with third-party data brokers to enrich customer profiles with publicly available information, without independently verifying the data broker's compliance with privacy regulations or obtaining explicit customer consent for this data enrichment. Option D. Implement the AI platform to deliver highly personalized marketing messages and product recommendations based on predictive analytics, ensuring all data collection is compliant with GLBA and relevant state privacy laws, with clear opt-out options for customers. The correct answer is D. Implement the AI platform to deliver highly personalized marketing messages and product recommendations based on predictive analytics, ensuring all data collection is compliant with GLBA and relevant state privacy laws, with clear opt-out options for customers. Explanation: this scenario is professionally challenging because it requires balancing the benefits of technological advancements in marketing with the imperative to protect customer data and maintain trust, all within the specific regulatory landscape governing insurance in the United States. The rapid evolution of technology means that marketing strategies must adapt, but this adaptation must not compromise compliance with consumer protection laws and ethical marketing practices. Careful judgment is required to ensure that data collection and usage are transparent, consent-based, and secure. The correct approach involves leveraging technology to personalize customer interactions and enhance the customer experience, while strictly adhering to data privacy regulations such as the Gramm-Leach-Bliley Act, GLBA, and state-specific privacy laws. This includes obtaining explicit consent for data usage, providing clear opt-out mechanisms, and implementing robust data security measures. Ethical marketing principles also dictate that personalization should not be manipulative or exploit vulnerabilities. An incorrect approach that relies on broad, non-specific data collection without clear consent for personalized marketing campaigns fails to meet regulatory requirements. This could violate GLBA provisions on safeguarding customer information and state privacy laws that mandate specific consent for data sharing and marketing. Another incorrect approach that uses predictive analytics to target individuals based on inferred sensitive information without explicit consent is ethically problematic and potentially discriminatory, violating fair marketing practices and potentially leading to regulatory scrutiny. A third incorrect approach that prioritizes aggressive digital advertising over customer privacy, perhaps by using third-party data aggregators without verifying their compliance or customer consent, risks significant legal and reputational damage. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory obligations related to data privacy and marketing in the U.S. insurance sector. This involves conducting thorough risk assessments for any new technology or marketing strategy, ensuring that customer consent is obtained and managed appropriately, and prioritizing transparency and data security. Continuous training on evolving regulations and ethical best practices is also crucial. Question 12. The audit findings indicate that the company's social media marketing team is not consistently monitoring and measuring the performance of its campaigns in a manner that fully aligns with regulatory expectations for customer data privacy and advertising integrity. Which of the following approaches to monitoring and measuring social media performance is most compliant with these expectations? Option A. Relying on unverified third-party analytics tools that promise deep insights into competitor strategies and audience demographics without explicit data source validation. Option B. Employing sophisticated web scraping techniques to gather detailed user interaction data from social media profiles for in-depth behavioral analysis. Option C. Focusing exclusively on the growth of follower counts across all social media platforms as the primary indicator of campaign success. Option D. Utilizing platform-provided analytics to track aggregated engagement metrics, reach, and sentiment, while ensuring no personally identifiable information is collected or analyzed beyond public profile data. The correct answer is D. Utilizing platform-provided analytics to track aggregated engagement metrics, reach, and sentiment, while ensuring no personally identifiable information is collected or analyzed beyond public profile data. Explanation: this scenario is professionally challenging because it requires balancing the need for effective social media marketing with strict adherence to regulatory requirements for monitoring and measuring performance. The challenge lies in identifying metrics that are both insightful for business strategy and compliant with data privacy and advertising standards. Careful judgment is required to ensure that the methods used to gather and analyze social media data do not inadvertently lead to non-compliance or ethical breaches. The correct approach involves selecting social media performance metrics that are directly tied to marketing objectives and can be tracked using publicly available platform analytics or approved third-party tools, while ensuring that no personally identifiable information (PI) is collected or used in a way that violates customer privacy regulations. This approach is right because it aligns with the principle of responsible marketing and data stewardship, specifically focusing on aggregated, anonymized data such as engagement rates, reach, and sentiment analysis, without delving into individual user behavior beyond what is publicly shared or consented to, upholds customer privacy, and avoids potential regulatory scrutiny under data protection laws. It also ensures that marketing efforts are demonstrably effective and can be justified to stakeholders. An incorrect approach that relies on scraping user data or tracking individual user journeys across platforms without explicit consent fails to comply with data privacy regulations. This is a significant regulatory failure, as it can lead to substantial fines and reputational damage. Another incorrect approach that focuses solely on vanity metrics like follower count without considering engagement or conversion rates is ethically questionable, as it misrepresents marketing effectiveness and can lead to misallocation of resources. Furthermore, an approach that uses unverified or biased third-party analytics tools without due diligence risks generating inaccurate performance data, which can lead to flawed marketing decisions and a failure to meet regulatory expectations for accurate reporting. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations from the outset. This involves understanding the specific data privacy laws applicable to the jurisdiction, identifying marketing objectives, and then selecting measurement tools and metrics that align with both. Regular review of social media policies and analytics practices against evolving regulations and ethical best practices is crucial. When in doubt, consulting with legal and compliance departments is essential to ensure all monitoring and measurement activities are robust and defensible. Question 13. Cost-benefit analysis shows that launching a new, complex insurance product with a higher commission structure could significantly boost an agent's earnings in the short term. However, the product has a steep learning curve and requires a deep understanding of its intricate features to ensure it is suitable for clients. The agent is aware of this complexity, but is also under pressure to meet quarterly sales targets. Which approach best aligns with the agent's professional responsibilities and regulatory obligations? Option A. Decline to sell the new product until comprehensive training is completed, ensuring a thorough understanding of its features, benefits, and limitations, and then proactively assess client suitability before making any recommendations. Option B. Immediately begin selling the new product to as many clients as possible, leveraging the higher commission to meet sales targets and address any client suitability questions as they arise. Option C. Focus sales efforts on existing, simpler products that are well understood, and only consider the new product for a select few clients who explicitly inquire about it, regardless of their actual suitability. Option D. Rely solely on the marketing materials provided by the insurer to explain the product to clients, assuming the materials accurately reflect the product's benefits and are sufficient for client understanding. The correct answer is B. Immediately begin selling the new product to as many clients as possible, leveraging the higher commission to meet sales targets and address any client suitability questions as they arise. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the immediate financial benefits of a new product launch with their fundamental duty to act in the best interest of their clients. The pressure to meet sales targets and earn commissions can create a conflict of interest, making it crucial for the agent to prioritize ethical conduct and regulatory compliance over personal gain. Careful judgment is required to navigate this conflict and ensure that client needs are met appropriately. The correct approach involves the agent proactively seeking comprehensive training on the new product, understanding its features, benefits, limitations, and suitability for different client profiles. This allows the agent to provide accurate and unbiased advice, ensuring that the product is recommended only when it aligns with a client's specific financial goals and risk tolerance. This aligns with the regulatory framework that mandates agents to act with honesty, integrity, and in the best interest of their clients, often referred to as a fiduciary duty or a duty of care, depending on the specific jurisdiction's legislation governing insurance sales practices. Providing accurate and suitable recommendations prevents misrepresentation and ensures client satisfaction, thereby upholding the agent's professional reputation and the insurer's brand. An incorrect approach would be to proceed with selling the new product without adequate knowledge, relying on superficial marketing materials or the insurer's enthusiasm. This failure to acquire necessary product knowledge constitutes a breach of the agent's duty to provide competent advice. It can lead to misrepresenting the product's benefits or failing to disclose crucial limitations, potentially resulting in clients purchasing unsuitable policies. Such actions violate regulations that prohibit misrepresentation and require agents to ensure product suitability, exposing both the agent and the insurer to regulatory sanctions, client complaints, and legal liabilities. Another incorrect approach would be to prioritize sales volume and commission earnings over client suitability. This involves pushing the new product to clients who may not benefit from it or even be harmed by it, simply to meet sales quotas. This directly contravenes the ethical and regulatory obligation to place the client's interests first. It can be construed as unethical sales conduct and a violation of consumer protection laws designed to prevent predatory sales practices. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the core ethical and regulatory obligations. Recognize the paramount duty to act in the client's best interest and adhere to all applicable laws and guidelines. 2. Assess potential conflicts of interest. Be aware of how personal financial incentives might influence decision-making. 3. Gather comprehensive information. Thoroughly understand the product, its target market, and its limitations. 4. Evaluate client needs and suitability. Objectively determine if the product is a good fit for each individual client's circumstances. 5. Seek clarification and training. Proactively address any knowledge gaps through insurer-provided resources or professional development. 6. Document decisions. Maintain records of client interactions and the rationale behind product recommendations. 7. Prioritize client well-being. If a conflict arises, always err on the side of caution and ensure the client's interests are protected, even if it means foregoing a sale. Question 14. The assessment process reveals that a marketing campaign for a Medicare supplement plan is being developed. The goal is to highlight the plan's ability to fill gaps in original Medicare coverage. However, there is a debate about how to best present this information to potential customers, many of whom are seniors with varying levels of health insurance literacy. One proposed approach emphasizes the plan's role in covering deductibles and coinsurance, while another suggests framing it as a way to enhance Medicare benefits. A third approach focuses on the premium savings compared to other types of coverage. Which of the following approaches best aligns with regulatory requirements and ethical marketing practices for Medicare supplement plans? Option A. Market the plan as a way to enhance Medicare benefits, implying it provides additional coverage beyond what original Medicare offers. Option B. Clearly explain that the Medicare supplement plan works with original Medicare to cover specific out-of-pocket costs like deductibles and coinsurance, and that it is not a replacement for original Medicare. Option C. Suggests that the Medicare supplement plan offers a more comprehensive package of benefits than original Medicare alone. Option D. Focus heavily on the lower premium cost of the Medicare supplement plan, without extensively detailing the specific benefits it covers or its relationship with original Medicare. The correct answer is B. Clearly explain that the Medicare supplement plan works with original Medicare to cover specific out-of-pocket costs like deductibles and coinsurance, and that it is not a replacement for original Medicare. Explanation. The assessment process reveals a common challenge in health insurance marketing, balancing the need to effectively communicate product benefits with the regulatory imperative to avoid misleading or deceptive practices. This scenario is professionally challenging because it requires a nuanced understanding of how to present information about Medicare supplement plans to a vulnerable population, ensuring clarity without overpromising or creating unrealistic expectations. The decision-maker must navigate the fine line between persuasive marketing and strict adherence to regulations designed to protect consumers. The correct approach involves providing clear, concise, and accurate information about the Medicare supplement plan's coverage, limitations, and costs, while also explicitly stating that it is not a Medicare Advantage plan and does not replace original Medicare. This approach aligns with regulatory requirements that mandate full disclosure and prohibit misrepresentation. Specifically, regulations like those enforced by CMS, Centers for Medicare and Medicaid Services, for Medicare supplement plans emphasize transparency regarding benefits, premiums, and the fact that these plans work in conjunction with, not as a substitute for, original Medicare. Ethical marketing also dictates that consumers should not be confused about the nature of the product they are purchasing, especially when it pertains to essential health coverage. An incorrect approach that misrepresents the Medicare supplement plan as providing benefits beyond what original Medicare covers, or implies it offers a comprehensive package similar to Medicare Advantage, constitutes a direct violation of regulatory guidelines. Such misrepresentations can lead to consumer confusion, financial harm, and regulatory penalties. Ethically, it is a breach of trust and exploits the consumer's potential lack of understanding. Another incorrect approach that focuses solely on the premium cost without adequately explaining the coverage limitations or the plan's role alongside original Medicare fails to provide essential information. This omission, while not an outright falsehood, can still be considered deceptive marketing if it leads consumers to believe they are purchasing more comprehensive coverage than they are. This violates the principle of informed consent, a cornerstone of ethical insurance sales. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Thoroughly understanding the specific product features and limitations. 2. Reviewing all marketing materials against relevant regulations, e.g., CMS guidelines for Medicare supplement. 3. Considering the target audience's potential level of understanding and ensuring the communication is clear and unambiguous. 4. Seeking legal or compliance review for marketing materials, especially for complex products like Medicare supplement plans. 5. Prioritizing consumer protection and transparency over sales volume. Question 15. Risk assessment procedures indicate that a new marketing campaign for homeowners insurance is being developed. Which of the following approaches best aligns with regulatory requirements for connecting with customers and promoting property and casualty products? Option A. Employ customer testimonials that highlight exceptional claim payouts without disclosing the frequency of such payouts or any potential biases in the selection of testimonials. Option B. Utilize vague language when describing coverage for business property, implying a wide scope of protection without explicitly detailing specific perils covered or excluded, to avoid overwhelming potential commercial clients. Option C. Focus exclusively on the most appealing aspects of the policy, such as low deductibles and comprehensive replacement cost coverage, while deferring detailed discussion of exclusions to the policy contract itself. Option D. Emphasize the broad protection offered by the policy, including detailed explanations of common perils covered, and clearly present any significant exclusions or limitations in a conspicuous manner within the marketing materials. The correct answer is D. Emphasize the broad protection offered by the policy, including detailed explanations of common perils covered, and clearly present any significant exclusions or limitations in a conspicuous manner within the marketing materials. Explanation. This scenario presents a professional challenge because it requires an insurance marketer to balance the need to effectively present property and casualty insurance products to potential customers with the imperative to adhere to strict regulatory requirements regarding fair representation and avoidance of misleading information. The challenge lies in crafting marketing materials that are both persuasive and compliant, ensuring that customers can make informed decisions without being subjected to deceptive practices. Careful judgment is required to navigate the fine line between highlighting product benefits and fulfilling disclosure obligations. The correct approach involves tailoring marketing messages to specific customer segments while ensuring that all essential policy terms, conditions, and limitations are clearly and conspicuously disclosed. This aligns with regulatory frameworks that prioritize consumer protection and fair marketing practices. Specifically, regulations often mandate that marketing materials do not omit material facts or present information in a way that could mislead a reasonable consumer about the scope of coverage, exclusions, or premium calculations. Transparency and accuracy are paramount to building trust and ensuring that customers understand what they are purchasing. An incorrect approach that focuses solely on highlighting the most attractive features of homeowners insurance without adequately disclosing significant exclusions or limitations would be professionally unacceptable. This failure constitutes a violation of regulations that prohibit deceptive advertising and require full and fair disclosure. Such an approach misrepresents the product's true value and can lead to customer dissatisfaction and potential legal repercussions for the insurer. Another incorrect approach that involves using vague or ambiguous language when describing commercial property coverage, such as implying broad protection without specifying the types of perils covered or excluded, is also professionally unacceptable. This lack of clarity can lead to a misunderstanding of coverage, leaving businesses vulnerable to unexpected losses. Regulations typically require that policy terms be presented in a clear and understandable manner, avoiding jargon or misleading statements that could obscure the actual coverage provided. A further incorrect approach that uses testimonials or endorsements without ensuring they are representative of typical customer experiences, or without disclosing any material connections between the endorser and the insurer, would be professionally unacceptable. This practice can mislead consumers into believing that the product's performance or benefits are more widespread or exceptional than they actually are, violating principles of truthful advertising. The professional decision-making process for similar situations should involve a thorough review of all marketing materials against applicable regulatory guidelines and ethical standards. Marketers should prioritize clarity, accuracy, and completeness in their communications. Before disseminating any marketing content, it is advisable to seek legal and compliance review to ensure adherence to all relevant laws and regulations. The focus should always be on empowering customers with the information they need to make informed choices, rather than on simply maximizing sales through potentially misleading tactics. Question 16. Compliance review shows that marketing materials for a new fixed annuity product are being prepared. The materials heavily emphasize the guaranteed income stream and tax-deferred growth potential, but they briefly mention surrender charges in a footnote and do not detail the impact of inflation on the purchasing power of the guaranteed income over time. Which approach to finalizing these marketing materials best aligns with regulatory requirements and ethical obligations for connecting with customers regarding retirement planning products? Option A. Remove all mentions of surrender charges and inflation to avoid confusing potential clients and focus solely on the guaranteed income and tax deferral benefits. Option B. Proceed with the current draft, as the core benefits are highlighted and the mention of surrender charges, though brief, satisfies disclosure requirements. Option C. Revise the materials to include a prominent section explaining the surrender charge structure, including the surrender period and applicable percentages, and add a clear explanation of how inflation can erode the real value of the guaranteed income over the long term. Option D. Add more complex actuarial tables to illustrate the guaranteed income projections, assuming a conservative inflation rate to demonstrate the long-term value. The correct answer is B. Proceed with the current draft, as the core benefits are highlighted and the mention of surrender charges, though brief, satisfies disclosure requirements. Explanation. This scenario presents a professional challenge because it requires balancing the company's marketing objectives with the fiduciary duty to act in the client's best interest, particularly when dealing with complex retirement products like annuities. The challenge lies in ensuring that marketing materials are not only persuasive, but also accurate, transparent, and compliant with all applicable regulations, preventing misrepresentation or omission of crucial information that could lead to poor client outcomes. Careful judgment is required to navigate the fine line between highlighting product benefits and adequately disclosing risks and limitations. The correct approach involves a comprehensive review of marketing materials to ensure they accurately reflect the features, benefits, and risks of annuity products, aligning with the client's stated retirement goals and risk tolerance. This approach is right because it prioritizes client understanding and suitability, which is a cornerstone of regulatory compliance and ethical conduct in financial services. Specifically, it adheres to the principles of fair dealing and suitability, ensuring that clients receive information that enables them to make informed decisions. Regulations typically mandate that marketing materials for annuities must be clear, conspicuous, and not misleading, providing a balanced view of both advantages and disadvantages, including surrender charges, fees, and the impact of market fluctuations on variable annuities. This proactive review process mitigates the risk of regulatory action, reputational damage, and potential litigation arising from missold products. An incorrect approach that focuses solely on highlighting the guaranteed income features of an annuity, without adequately disclosing the potential for lower returns on fixed annuities compared to other investment vehicles, or the complexity and fees associated with variable annuities, fails to provide a complete picture. This omission can lead clients to overestimate potential gains or underestimate the costs and risks involved, violating the principle of full disclosure and potentially leading to unsuitable product recommendations. Another incorrect approach that emphasizes the tax-deferred growth aspect of annuities without clearly explaining that this benefit is primarily realized upon withdrawal and that early withdrawals may incur penalties and taxes. This represents the immediate value proposition. This selective disclosure can create unrealistic expectations about immediate tax savings or liquidity, which is ethically problematic and likely to contravene regulatory requirements for transparency. A third incorrect approach that uses overly technical jargon or complex illustrations without providing clear, plain language explanations of annuity features, such as death benefits, living benefits, or riders, hinders client comprehension. This lack of clarity can obscure important details about the product's performance, costs, and limitations, making it difficult for clients to make truly informed decisions and potentially violating regulations that require clear and understandable communication. The professional decision-making process for similar situations should involve a systematic review of all marketing materials against regulatory requirements and ethical standards. This includes 1. Understanding the target audience and their level of financial sophistication. 2. Ensuring all claims made are substantiated and can be verified. 3. Providing a balanced presentation of both benefits and risks. 4. Using clear, concise, and easily understandable language. 5. Seeking legal and compliance review for all materials before dissemination. 6. Prioritizing client best interest above sales targets. Question 17. What factors determine the ethical and regulatory appropriateness of using market research data to segment potential customers for insurance products? Option A. The ease with which customer data can be acquired and analyzed, prioritizing speed and cost-effectiveness over the nature of the data used. Option B. The degree to which the segmentation strategy leverages broad demographic categories to simplify marketing efforts, even if it leads to generalized assumptions about customer needs. Option C. The extent to which the segmentation strategy is based on objective, non-discriminatory criteria and respects customer privacy, aligning with fair marketing practices and data protection laws. Option D. The potential for the segmentation strategy to maximize short-term sales revenue by targeting individuals perceived as most likely to purchase, regardless of data privacy or fairness. The correct answer is C. The extent to which the segmentation strategy is based on objective, non-discriminatory criteria and respects customer privacy, aligning with fair marketing practices and data protection laws. Explanation. This scenario is professionally challenging because it requires an insurance marketer to balance the need for effective customer segmentation with the imperative to comply with regulatory requirements regarding data privacy and fair marketing practices. Misinterpreting market research findings or applying them inappropriately can lead to discriminatory practices, breaches of customer trust, and significant legal and reputational damage. Careful judgment is required to ensure that market research informs strategies without leading to unfair treatment or the misuse of sensitive customer information. The correct approach involves using market research to understand customer needs and preferences in a way that allows for tailored product development and communication, while strictly adhering to all applicable privacy laws and ethical marketing guidelines. This means ensuring that any segmentation is based on legitimate, non-discriminatory factors, and that customer data is handled with the utmost care and transparency. Regulatory frameworks, such as those governing data protection and consumer rights, mandate that marketing efforts are fair, transparent, and do not exploit vulnerabilities or lead to unfair discrimination. Ethical considerations further reinforce the need to treat all customers with respect and to avoid practices that could be perceived as predatory or exclusionary. An incorrect approach that relies solely on demographic data without considering behavioral or psychographic factors can lead to overly broad assumptions about customer needs and preferences, potentially resulting in ineffective marketing campaigns and missed opportunities. Furthermore, an approach that prioritizes aggressive sales tactics based on perceived customer vulnerability, without regard for their actual needs or the regulatory prohibition against unfair or deceptive practices, is ethically unsound and legally problematic. Another incorrect approach might involve using sensitive personal information obtained through market research for purposes not disclosed to the customer, thereby violating privacy regulations and eroding trust. Professionals should employ a decision-making framework that begins with a thorough understanding of the regulatory landscape and ethical principles governing insurance marketing. This framework should involve 1. Defining clear objectives for market research that align with business goals and customer well-being. 2. Identifying and collecting relevant data ethically and legally, ensuring consent and transparency. 3. Analyzing data to identify meaningful customer segments and insights, avoiding discriminatory or stereotypical interpretations. 4. Developing marketing strategies that are tailored, relevant, and respectful of customer privacy and preferences. 5. Regularly reviewing and auditing marketing practices to ensure ongoing compliance and ethical conduct. Question 18. Examination of the data shows that the marketing department has implemented several new initiatives aimed at increasing policy sales and customer engagement. To assess the effectiveness of these initiatives and their return on investment, which of the following approaches would be most appropriate for measuring marketing effectiveness? Option A. Attributing all recent policy sales increases directly to the most recently launched marketing campaign, regardless of other contributing factors. Option B. Prioritizing a significant reduction in overall marketing expenditure without a detailed analysis of its impact on customer acquisition and retention. Option C. Focusing solely on the increase in website traffic and social media engagement metrics following the launch of new campaigns. Option D. Analyzing the correlation between specific marketing touchpoints and customer conversion and retention rates, considering the entire customer journey. The correct answer is D. Analyzing the correlation between specific marketing touchpoints and customer conversion and retention rates, considering the entire customer journey. Explanation. This scenario presents a common challenge in marketing, attributing success to specific initiatives when multiple factors influence customer acquisition and retention. The professional challenge lies in accurately measuring the effectiveness of marketing efforts to justify expenditure and optimize future strategies, all while adhering to regulatory requirements for fair and transparent marketing practices. Careful judgment is required to select metrics that are both meaningful for business objectives and compliant with ethical marketing standards. The correct approach involves a comprehensive analysis of customer journey data, linking specific marketing touchpoints to conversion and retention rates. This method allows for a nuanced understanding of which campaigns are driving desired outcomes, such as policy sales or customer engagement, and which are not. From a regulatory and ethical standpoint, this approach supports responsible marketing by ensuring that resources are allocated to strategies that genuinely benefit customers and the business, avoiding wasteful or misleading campaigns. It aligns with the principle of demonstrating value and avoiding deceptive practices by focusing on tangible results. An incorrect approach would be to solely rely on easily quantifiable metrics like website traffic or social media likes without correlating them to actual business objectives like policy sales or customer lifetime value. This fails to measure true marketing effectiveness and can lead to misallocation of resources. Ethically, it can be misleading to stakeholders if the reported success is not grounded in actual business impact. Another incorrect approach is to attribute all positive outcomes to the most recent marketing campaign, ignoring the cumulative effect of ongoing efforts or external market factors. This oversimplification leads to inaccurate ROI calculations and can result in the discontinuation of valuable, long-term marketing strategies. It also fails to provide a clear understanding of customer behavior and the true drivers of success. A third incorrect approach is to focus exclusively on cost reduction in marketing without considering the impact on customer acquisition or retention. While cost efficiency is important, marketing strategy that drastically cuts spending without a clear understanding of its effect on customer engagement or sales can ultimately harm the business and its ability to connect with customers effectively. This can lead to a decline in market share and customer satisfaction, which can have long-term negative consequences. The professional decision-making process for similar situations should involve establishing clear, measurable marketing objectives aligned with business goals. This includes defining key performance indicators, KPI, that reflect both marketing reach and business impact, such as customer acquisition cost, CAC, customer lifetime value, CLTV, and conversion rates at various stages of the customer journey. Regularly reviewing and analyzing data against these KPIs, using a combination of attribution models and qualitative feedback, allows for informed adjustments to marketing strategies. This data-driven approach ensures that marketing investments are effective, ethical, and compliant with all relevant regulations. Question 19. When evaluating the evolution of insurance marketing, a seasoned marketing manager recalls successful, albeit aggressive, direct mail campaigns from the 1980 that emphasized fear-based appeals to highlight the need for life insurance. The manager is considering adapting these tactics for a new campaign targeting younger demographics, believing the core message of protecting loved ones remains relevant. Which approach best aligns with current regulatory frameworks and ethical marketing principles for the insurance industry? Option A. Focusing the campaign solely on price competitiveness, believing that cost is the primary driver for younger consumers, and downplaying the complexities of coverage. Option B. Adapting the core message of protection, but modernizing the communication style to be informative and transparent, focusing on the benefits and features of life insurance in a clear, factual manner, and ensuring compliance with all current advertising and disclosure regulations. Option C. Utilizing social media influencers to promote the fear-based messaging from the 1980, trusting that the platform's reach will amplify the message effectively. Option D. Replicating the 1980s direct mail campaign's aggressive tone and fear-based appeals, assuming that younger consumers will respond similarly to the urgency conveyed. The correct answer is B. Adapting the core message of protection, but modernizing the communication style to be informative and transparent, focusing on the benefits and features of life insurance in a clear, factual manner, and ensuring compliance with all current advertising and disclosure regulations. Explanation. This scenario presents a professional challenge because it requires balancing the historical evolution of insurance marketing practices with current ethical and regulatory expectations. The challenge lies in recognizing that what may have been acceptable or common in the past might now be considered misleading or unfair under contemporary consumer protection laws and ethical marketing standards. Careful judgment is required to ensure that marketing efforts, even when drawing inspiration from past successes, adhere strictly to current legal and ethical frameworks designed to protect consumers. The correct approach involves adapting historical marketing strategies to align with current regulatory requirements and ethical principles. This means understanding the evolution of consumer protection laws and marketing ethics, and applying these modern standards to any marketing initiative. Specifically, it requires ensuring that all communications are clear, accurate, and not misleading, and that vulnerable consumers are not exploited. This approach is ethically sound and legally compliant because it prioritizes consumer welfare and upholds the integrity of the insurance industry by adhering to the spirit and letter of current regulations, which are designed to foster trust and transparency. An incorrect approach that relies solely on past successful marketing tactics without considering their current legality or ethicality fails to acknowledge the significant evolution of consumer protection laws and ethical marketing standards. This can lead to regulatory violations, such as misrepresentation or deceptive practices, which can result in fines, reputational damage, and loss of consumer trust. Another incorrect approach that prioritizes aggressive sales tactics over consumer understanding risks, exploiting information asymmetry, and potentially leading consumers to purchase products that are not suitable for their needs. This is ethically problematic and can also contravene regulations that mandate fair dealing and suitability. A third incorrect approach that focuses on historical marketing methods without considering the impact on diverse customer segments may inadvertently perpetuate discriminatory practices or fail to reach all potential customers equitably, which is both an ethical failing and potentially a regulatory issue under fair marketing and non-discrimination principles. Professionals should employ a decision-making framework that begins with a thorough understanding of the current regulatory landscape and ethical guidelines governing insurance marketing. This involves researching applicable laws and industry best practices. Next, they should critically evaluate any proposed marketing strategy, including those inspired by historical methods, against these current standards. This evaluation should consider potential impacts on consumers, particularly vulnerable groups, and assess the clarity, accuracy, and fairness of all communications. If historical strategies are to be adapted, the focus must be on how to modernize them to be compliant and ethical, rather than simply replicating past actions. This proactive and compliance-focused approach ensures that marketing efforts are not only effective, but also responsible and sustainable. Question 20. Stakeholder feedback indicates that some prospective customers are misunderstanding the long-term value proposition of a new insurance product due to the current marketing materials emphasizing immediate benefits. Which approach best aligns with marketing ethics and compliance requirements for connecting with customers? Option A. Instruct the sales team to verbally clarify the long-term value proposition during customer interaction without altering the written marketing materials. Option B. Continue with the current marketing strategy, as the emphasis on immediate benefits is a standard and effective sales tactic. Option C. Proactively review and revise marketing materials to clearly articulate both immediate benefits and realistic long-term outcomes, including any limitations or conditions. Option D. Make minor cosmetic changes to the marketing materials to appear responsive, without fundamentally altering the messaging about immediate benefits. The correct answer is C. Proactively review and revise marketing materials to clearly articulate both immediate benefits and realistic long-term outcomes, including any limitations or conditions. Explanation. This scenario presents a professional challenge because it requires balancing the company's marketing objectives with the ethical obligation to provide accurate and non-misleading information to potential customers. The core of the challenge lies in interpreting and applying marketing ethics and compliance guidelines to a situation where a product's benefits might be perceived differently by various stakeholders. Careful judgment is required to ensure that marketing materials are not only persuasive, but also truthful and compliant with regulatory standards, preventing potential harm to consumers and reputational damage to the company. The correct approach involves proactively addressing the stakeholder feedback by reviewing and potentially revising the marketing materials to ensure clarity and accuracy regarding the product's limitations and realistic outcomes. This aligns with the ethical principle of transparency and the regulatory requirement to avoid deceptive advertising. By seeking to clarify the messaging and provide a more balanced representation, the company demonstrates a commitment to customer well-being and regulatory adherence, fostering trust and long-term relationships. This approach prioritizes ethical conduct and compliance over short-term sales gains that might be achieved through ambiguous or potentially misleading statements. An incorrect approach that focuses solely on the positive aspects of the product without acknowledging its limitations risks misrepresenting the product's value. This can lead to customer dissatisfaction and potential complaints, which could trigger regulatory scrutiny. Such an approach fails to uphold the ethical duty of honesty and the regulatory imperative to provide clear, accurate, and non-misleading information. Another incorrect approach that involves downplaying or ignoring the stakeholder feedback, assuming the current marketing is sufficient, neglects the importance of continuous improvement and responsiveness to customer concerns. This can be interpreted as a disregard for ethical marketing practices and a failure to proactively manage compliance risks. It also misses an opportunity to strengthen customer relationships by demonstrating attentiveness to their perspectives. A further incorrect approach that involves making minor, superficial changes to the marketing materials without genuinely addressing the core concerns raised by stakeholders is also professionally unacceptable. This approach can be seen as a form of compliance avoidance, where the appearance of action is prioritized over substantive ethical and regulatory adherence. It fails to build genuine trust and may still leave the company vulnerable to accusations of misleading practices. Professionals should adopt a decision-making framework that begins with actively listening to and analyzing stakeholder feedback. This should be followed by a thorough review of current marketing practices against relevant ethical guidelines and regulatory requirements. The next step involves identifying any discrepancies or areas of potential misinterpretation and developing a plan for corrective action, which may include revising marketing materials, enhancing training for sales staff, or improving product disclosure. Finally, it is crucial to monitor the effectiveness of these changes and remain open to further feedback, fostering a culture of continuous ethical improvement and compliance.